Welcome to Investment 360 in the hot seat this evening. Mark Witten, Managing Director of Kaizen Asset Management. Well, we put it out there, Mark, that retailers are looking expensive in your book, but the addition to that is, of course, to ignore them at your peril. What would you do right now with the likes of a Massmart and a ShopRite? Do you short them?
No, I mean, I've seen this game before. It's definitely not the locals buying ShopRites and Massmart. So I think, like I said during the break, it's like drinking out of a fire hydrant. You can get a lot more than you bargain for. So I wouldn't be shorting them right now, although, you know, if I look at Massmart, which is going to earn, call it 7 Rand going forward, I mean, trading at 170 Rand, it just doesn't seem like reasonable value. ShopRite, you know, to me for the same reasons. I think there's still value in Woolies. I think Spar's also had a tremendous run. And when you look at what's happening on, you know, the fuel prices are pretty much the highest they've ever been, give or take. You've had an increase now in fuel retail levies, and you're going to have the road tariffs coming in next year. So I think Spar's business model is under threat. It's going to be under pressure. Pick n Pay, to me, even though they've managed to win the Franklins and, you know, that competition commission
Finally,
case.
how long did that take? I mean, that was years and years,
July,
I'm sure.
Yeah, July last year it was supposed to be concluded. And they've repatriated some cash back, and at least they're not going to be funding a loss-making operation on South African cash flows. But the reality is they're still very far behind on their distribution centre strategy. I think they still haven't placed themselves very well in terms of a brand, and they've spent a lot of money on this loyalty program that I don't think is realising great dividends. So I still see sort of value in Woolies. Overall, though, I think the South African consumer themselves, you know, is looking forward is going to be under quite a bit of pressure. These electricity hikes are
exactly what we were
again.
saying with the
Road
Spurs
tariffs,
CEO just a moment
But
ago.
let's just take that a bit further, Mark. Let's assume that we go into a scenario next year where their consumer comes under much more pressure. In other words, we find that inflation has moved up quite a bit. Salaries are not going up at a pace that is well above inflation. So we've seen companies then moderate wage increases. Inflation then pushes up against salaries a lot more aggressively. And we're finding that consumers are now facing all of those higher water tariffs, higher electricity tariffs, maybe the toll roads eventually come in. Under those circumstances, which of the retailers do you think hold up a little bit better? Is it a sense that then consumers start to use credit, and you're looking at the credit retailers, that because we've seen unsecured credit in South Africa pick up?
Yeah.
Or is it a Woolies that is more at the higher LSM?
Yeah, I mean, for me, there would be two that stand out for two different reasons. ShopRite stands out because they target the lower LSM of the market, and there's been a large increase in social grants. So I think they're also heavily, they sell more on the commodity side, a lot of maize, etc., and that's up sort of 70% year on year. So I think ShopRite will benefit. I think Woolies is more of a price setter rather than a price taker. Their segment of the market, as much as they might be under pressure, the proportion of food in terms of their earnings, the proportion that food accounts in terms of their monthly spending is really not all that significant. You know, for the high LSMs to spend 2,000 or 3,000 Rand a month on food is not exactly, it's not a huge chunk
Which
of their
means
salary.
that Pick n Pay then gets left a little bit in no man's land in a sense.
So too. I think Walmart is going to transfer a lot of best practice to Massmart. Like I said, I think Spar is going to be under the most pressure, but Pick n Pay, to me, they just, you know, there's a lot of structural problems in the business. Look, it's not as bad as, let's say, there's some construction companies locally that are facing real structural problems in the industry that they've got no control over. The retail sector is in good shape in South Africa. They've been increasing their ROEs over the last 10 years consistently. They've got a lot of cash on their balance sheets, except for Pick n Pay. And going forward, the South African consumer, there is still an emerging middle class. There is still a lot of money going into social grants. So I don't think it's going to be, I personally can't see why you'd be paying 25 historic PE and a 24 PE for a company that's going to grow.
Let's talk about this foreign effect, though, because it's again a debate that we've had for a long time. Why do the South African retailers going up? And of course, the old argument is that they are comparatively cheap when you look at the international emerging retail landscape, and that foreigners are going to continue to push our valuations higher.
Yeah, potentially. And then they also can drive them like they did in January this year, where they knocked them down 15-20% over like it was 5 or 6 trading days. You know, when they buy aggressively, and our market is very reasonably thin and illiquid. And, you know, when they sell, they do the same. I mean, there is, to me, an arbitrage there in that we live here, we placed here, we generally have a better understanding of management and of the retail companies which are better performers, etc. So, you know, to me, the reality is, look, in terms of volatility, that's not permanent capital loss. You know, the share prices can run or come back, and there's opportunities to buy or sell them. But I mean, I wouldn't bet against that.
What's your position right now? You've given us a lot of detail around the individual stocks, yes, on the retail front.
We short retail. We think the banks are starting to look attractive. We've gone net long on the banks. we're still very much positive on the rand hedges, the defensive rand hedges, with focuses on growing emerging markets.
Before we move to the banks, why? Why have you gone net positive on the banks?
I think number one, if I take a look at the corporate balance sheets in South Africa, they're a lot healthier than they were, and there's excess cash and excess capacity. But I think you're going to start seeing expansion next year. And I think the property market, as much as, we're in the doldrums right now, but I think banks have just underperformed so dramatically against the retailers, etc. And it is also an interest rate play. We do expect an interest rate cut going forward. We hope for one anyway. But I think our banks locally are not in any trouble compared to the European banks.
With the move today, we had a big move in the banking sector today. Would you see that as part of a catch-up from banks on the back of some resolution in Europe? The argument being that if you get more clarity around the European situation, the European banks aren't as vulnerable, and you get some money going into the banking sector generally, and South Africa's banks benefit out of that.
That's partly, I think definitely that could be a good argument. The banks are the center of your economy. Whatever you want to do, be it private spending or, any kind of credit, the banks have to come to the party. In my mind, FirstRand is exceptionally well run. Standard Bank has a bit of exposure to Europe, and I think that makes me a bit nervous, as does the Investec. So, locally,
would you be following the unsecured credit that's coming through from Capitec and Able?
We very much like the story, particularly like Able, our rate management, and I think they've got a great business model, and they've also taken on a lot of business that the banks have turned down.
And you think Ellerines is now working for them? Because the timing of that acquisition wasn't exactly peachy.
I think it's like Zimbabwe. It's getting less worse. Maybe not getting 100% better, but it's not a winning formula just yet. But I think they are well placed. And if you go into the rural areas where the social grants are, flowing towards, you find the likes of PEP and Ellerines and Capitec, and that's where the growth is going to come from. So, yeah, I think it's not a bad story.
How are you feeling about the microlenders in South Africa?
But look, it's the only story in terms of credit that's going on. It's making me a little bit nervous because of the rate at which it's growing. Not the fact that it's growing, because I think there's a reasonable rationale around that. But these numbers have been growing at over 30%. And when I see a credit number that's as big as that grow at that sort of magnitude, you have to ask questions. That expansion is too rapid, and because
it's not sustainable, in other words.
It's not sustainable, and you must be making mistakes. So you hear this constant argument that the margin is big enough to absorb the bad debts. Well, we've heard that argument in other countries as we've gone along. So it's the magnitude of the growth that worries me. I do buy the idea that Capitec and Able are extremely well versed in this market segment, better than the conventional banks, and you could make an argument that they know what they're doing. But I would just caution about hiding behind that notion. So to me, it's interesting. We would prefer Able versus Capitec. Capitec is too expensive, but watch it. It's growing too fast. There are risks building up.
And the big four are going aggressively after this space because, as we've highlighted, this is where the growth potential lies.
That's where all the majority of the unbanked population is, in the lower LSMs, obviously. So, yeah, they will be aggressively competing, and they have the infrastructure and the resources to make real inroads quite quickly. I think a lot of them also looking north. You see FirstRand won a banking license now. It's open in Nairobi. They're in Tanzania. I think the growth is, the reality is the likes of Walmart and the interest in our bourse and in coming to South Africa is not South Africa. The South African story is not, we're going to have GDP growth of 2.5%, 3% at best, and we've got cost inflation in terms of electricity, road tariffs of 25%, 30%. And unemployment is still rising. It's not falling, especially as the construction sector and mining sector don't really invest. So I think the story is a sub-Saharan African story, particularly the likes of Mozambique, Zimbabwe.
I want to push you more on the stocks, though, because obviously Standard Bank has had first move advantage on the African continent. That's why it's always been at a premium to the other banks. Obviously had its own troubles, has come back. Talk a little bit more about the big four and how you perceive them in terms of value.
Okay, look, personally, we like FirstRand. We rate FirstRand as probably the best managed bank and also one of the most conservative, but they generally seem to act ahead of the curve. I agree Standard Bank has got a first move advantage to Africa, but they also have significant exposure to markets, like in Europe, that really aren't doing well. As I've said before, I know it's cold in the Antarctic. I don't need to go there myself to find out. Europe is in a very precarious position at the moment, and there could realistically be a proper run on the euro. Nobody can tell at this point in time. It's kind of who's going to blink first. Nedbank,
it's like being in a casino at the moment. Red, black, you're not kind of sure which way it's going to swing.
At the moment. Look at the market movements. You have a 4% move in one day on the back of, a couple of statements, and then it comes back again, and we'll see on Thursday or Friday. The market is very much, it's extremely volatile. I haven't traded this kind of volatility it's up or down 8 to 10% on a monthly basis.
But you look very calm and collected.
We've reduced our exposure and moved to cash mostly.
That's the medication that's kicking in.
The medication is also working. No, we've had a great year. We've done really well for the year, and we've reduced our gearing and our exposure, and we still have positions, and we're working on next year's positions, and we just kind of.
So first round's your best.
First round's
play?
a top pick. To be honest with you, I'm not a big fan of Nedbank or of ABSA, particularly Nedbank on the local side, on the housing side. I think that they entered the cycle too late, and they seem to be trying to aggressively enter the cycle again. I think ABSA's got a reasonably good balance sheet. It's got, my problem with ABSA is the costs have been rising quite a bit. And I took a look at how much their costs were rising relative to what their, the increases were. It was way over target. So, but I'm not. I think banks essentially, what you have to remember is they are a macro call. They, as much as you can play the micro within banks, they're definitely a macro call.
Is it too early for construction stocks?
I think it's too late for them, to be honest with you. Look, I mean, what you need to understand about construction stocks is that, when a tender comes out for a prison or a road or a school, then everybody puts their tenders in, and then it's adjudicated, and then it's awarded, and then so the work they're winning now will only show up in 2013's earnings, 2012, 2013. We went to Group 5 Investor Day recently, and their loss-making projects as a percentage of total has gone from 10% to 25%, and I would assume it's going to go as high as 40 to 50%, as a lot of these guys were tendering in the good days at 7 and 8% margins, and we're delivering, if you made a mistake, you delivered a 4 or 5% margin. Now you're tendering at 1%. You've got 60-10, you're meeting 60
so
different
the landscape of the industry has changed.
I find it dramatically. There's been no big chunky projects. Plus, banks are getting very nervous funding these construction companies. And construction is a balance sheet game in that you need to post performance bonds if you win a big tender. From what I can tell, I think you're going to see a lot of these companies have to come to market next year to raise further capital.
So we won't see value unlock, because those value guys out there are all saying that this is a no-brainer. You've got to be in. You don't want to wait too late, they will re-rate.
No, it's why. First of all, what happened between 2003 and 2010, call it, that's never going to happen here again. The National Credit Act will ensure there's not going to be much of a bubble in the housing market. The government's not spending. There's no new World Cup. So in my mind, you had this perfect storm of factors, and look at how much work came out. And right now, and then these construction companies, they put capacity in place. So they expanded aggressively to meet demand, and now the government's it's choked them off. And now they're all going into Africa, and they've done this before. The last time they went into Africa, they all got reasonably hurt. They lost their shirts. This time, they seem to be, some of the companies are a bit smarter. They're going in on the back of mining money with the retailers, etc.
Mark, I am being wrapped over the knuckles. I've gone too long in this interview.
No
It's
worries.
great chatting to you. Thank you very much.
Thanks.
Mark
Thanks
Witten
very much.
from Kaizen Asset Management.